Hello and welcome to Inside Track. I'm Faith Glasgow, I'm the editor of Money Observer, and with me here today is Duncan MacInnes, who is one of the fund managers of the Ruffer Investment Company. So to kick off, Duncan, could you tell me something about the recent buys and sells in the portfolio?
Yeah, I think the volatility that we saw in Q4, of course the market was down sharply, created quite a lot of dispersion in markets, so it threw up a reasonable amount of new opportunities which we've been looking to. And I would say, if I was to put a theme on it, we've found quite a few reasonably high quality, faster growing companies which, because the market sold off, became cheap enough for us to look at. So to put some specific names around that, I would say Sony in Japan is a stock that we've owned for a while, but we got to add to at very good prices. And Activision Blizzard, which is a US gaming company, which has been very high growth and on a high valuation until it sold off in Q4 and gave us that opportunity.
Are there other assets that the portfolio also holds as well as equities, presumably?
Yeah, so we have a multi-asset portfolio. We'll go anywhere in the world and own almost anything if we think it's attractive. So today only about 40% of the portfolio is in equities globally, and the rest is a mix of what we call protection assets, and the bulk of that is inflation-linked bonds, not conventional government bonds, always inflation-linked, and things like gold and what we call our unconventional protections.
What about the fear factor? I mean, there are a number of things that investors have got good reason to be fearful of. Are there any particular issues that you see as kind of coming to the fore and becoming a problem, either in the near term or further down the line?
Yeah, I think there's a lot of known risks. So asset prices are very high. Geopolitics has become very important over the last few years and is moving from a cooperative game to a competitive one. Countries are going head to head. Investors, because of low interest rates, have been forced to reach for yield when they're making their investment decisions. But these are all known risks. I would say a more unknown risk is in corporate credit markets, so corporate bonds. That segment has grown hugely over the last 10 years because low interest rates have forced investors to look for yield. Corporates have taken advantage by borrowing enormous amounts of money. But the closer you look at that sector, the more problems you see. So there's a significant liquidity issue, that the underlying bonds are not liquid, and yet they're held in daily trading ETFs and mutual funds. So that's a big red flag. And down another level, when you look at the specifics of the underlying bonds, the average corporate investment grade bond has more leverage and fewer protective covenants for investors than they did pre-financial crisis. So that to us is an area of great concern and something that we're hedging against in the portfolio. Do
you not hold any?
We don't hold any, and we're actively betting on the prices falling.
Finally, could you tell me a little bit about any other particular stocks that you've been interested in?
The biggest holding in the portfolio today is Walt Disney Corp, which of course everyone will know, because it has this amazing library of intellectual property assets. So they have the Disney brands, but they also have Star Wars, Pixar, Marvel, and because of the 21st Century Fox acquisition, they have Avatar and The Simpsons and all sorts of other stuff too. And they've been, for decades, incredibly good at acting like a tax on parenthood, monetizing those assets via the theme parks and the cruise ships and the movies and the consumer products. But the new thing that they've done is launch a streaming service which looks a bit like Netflix. And I think as investors start to use their imagination to see exactly how big that product could be, the stock offers a really exciting growth opportunity going forward.